Hey, what's going on, guys? My name is Dayton. I'm the Chief Revenue Officer over here at Niche Capital. And today I want to explain what factoring loans are. So factoring loans are really cool for a few different reasons. If you're a company and maybe you have to wait for payment on your invoices, factoring loans are the way you can work around that. You take your invoice to a bank and the bank is going to use your invoice as collateral. They're going to lend against your receivables, or they're going to collateralize your receivables. All that means is that if you default on the loan, they're going to take ownership of the invoice that a company is payable to you. Now, the reason that's actually really important and a good thing is because when there's collateral, the interest rate's a lot lower. So the bank's going to say that XYZ company owes your company $100. Okay, great. There's not going to be any type of personal guarantee. They're going to collateralize the receivables, and your typical interest rate is going to be only 1 to 7%, which as a business owner, you know, that's cheap money. Typically and historically, when you look at rates given on factoring loans, they're really about only 1 to 4%. It's very affordable, very cheap money. The cost of funds is very low. And I'm sure if you speak to your CPA, you can write off any type of loan costs associated with the factoring loan. Another thing is a bank is going to lend you 70 to 90% of what's payable on the invoice. So you take your invoice to a commercial lender like Niche Capital, you take it to a big bank, they're gonna typically lend you 70 to 90%. What does that mean? That means if you come in with an invoice for $100,000, a bank's typically gonna give you $70 or $90. And then when the invoice is paid to you, when XYZ company pays your company and essentially pays the invoice, you're going to be able to keep the additional $30 or the additional $10. Again, banks lend 70 to 90%. That means there's either 30% or 10% left over. So you're going to be able to keep the remainder. However, the bank's going to take some type of very small, modest fee. Again, we can look at rates here. They're 1 to 7%. So you might borrow from the bank, let's say $70 and end up paying them back $72 on a $100 invoice. So again, the reason that I think you guys are gonna like these loans is one, they're very cost effective. With interest rates nowadays being super crazy and high, this structure of loan really gives some relief to the business owner that can't wait 30, 60, or 90 days to get paid from their customer. Another good option, and what a lot of people do these invoices, the way a lot of lenders structure this, is they just simply give you a line of credit and collateralize it with your invoices. So instead of giving you a lump sum up front, they just give you a line of credit. The underwriter dictates what the amount is, or the balance, the draw, forgive me, of the line of credit. And then you can just draw against it and repay it, but they will take your invoices as collateral, which again, collateral is good. When you hear collateral, you think, oh, that's awesome. I get typically a much lower interest rate, which you'll see here when I break down what equipment financing is and how rates are similar, if not better. So I want to break it down for you guys to understand. And that way, you're not sitting on a bunch of invoices with no money in the bank. You're able to actually say, hey, you know what? I can turn this invoice into cash. Let me go to nichecapitalco.com, hit apply. I know I got some invoices and I'd like to get an advance on them. All right, guys, thanks so much for watching. I'll talk to you soon.